Hello investors, welcome to Wisdom Owl. Today we are going to look at one of the undervalued companies from technology sector, which is Lyft. Lyft is currently a $6 billion market cap company and can see some strong revenue growth in coming years. Based on this strong revenue growth projection, the company is currently undervalued. Let's understand why. In next 5 minutes, first we are going to understand investor summary and learn how this company makes money. Then we are going to look into financial health and what has happened in the company in the last 5 years. Based on that, we are going to project how much revenue can they grow in coming years. And based on that revenue projection growth, we are going to understand what is the right valuation. So let's begin. So Lyft make money through their app, which they have in North America and Europe market currently, and they monetize through commissions. They reported in Q2 2025 that their revenue mostly comes from the ride-hailing commissions. They have also recently tied up with Baidu Apollo, where they are going to launch autonomous vehicles in Europe in 2026. They also acquired FreeNow for $175 million recently in order to increase their European footprint. They're also innovating with programs like Lyft Rewards for their drivers and Lyft Silver for their senior citizens. There can be some investment opportunities and risks in Lyft. As we talked, the growth driver, which comes from the autonomous vehicle deployment in Europe, they have a competitive advantage with programs like Lyft Silver. They're showing financial strength. They're also buying back their share. In terms of the strategic initiative, they have acquired FreeNow to enter into the Europe market to diversify their revenue. There are also some risks involved. There's intense competition, which is pressuring their pricing and margins. Uber scale may restrict Lyft's market share. Other than this, there are some operational risk and industry risk. For example, they are dependent on the drivers and they are vulnerable to economic downturns and regulatory changes. And that could elevate operating cost. Still, there are some open questions which need deeper dive. If you want to understand how the new regulations impact Lyft drivers classification and cost, you can go through app.wisdomowl.ai and go through these questions and the analysis in more detail. Now let's talk about what has happened in the company in last 5 years. If you see, the company's stock price has gone from $70 to currently trading at $17. And if you see, they have turned positive in the last financial year. It's important to understand how or what has changed in last 5 years. Lyft demonstrates compelling operational turnaround with improving profitability metrics and positive free cash flow generation. But there are some liquidity concerns and competitive pressure, which requires ongoing monitoring. And the company has shown promising progression towards sustainable unit economics in the competitive ride-sharing industry. So these are some of the top key metrics which an investor should be looking at. Their return on invested capital has not yet turned positive, but it's on a growing trajectory, right? If you see, the free cash flow per share has turned positive from 2024, and even in trailing 12 months, it is showing good growth. So it's a green signal. Similarly, their net profit margins, as we talked, have just turned positive in last financial year. The gross profit margins are still between 40 and 45%, which shows intense challenges and insurance cost fluctuation in the competitive ride-sharing industry. Similarly, there are some more metrics which the investor should be looking into. In terms of the revenue growth, they have seen considerable revenue growth from $7 per share to around $14 per share in the trailing 12 months. In terms of the valuation, it is trading at just 1.11 times its current sales, right? So there has been a significant compression from pandemic highs, but the current level suggests reasonable valuation for growth stage technology platform. And if you want to go into more details, you can log on to the platform and read. Now, let's talk about what the future outlook could look like. Since Lyft exhibits stable growth with a mature early growth stage earnings profile company, right? It's a company which is in the early growth stage. So it makes revenue the ideal metric for evaluating expansion because there is a lot of fluctuation in the profitability right now. And now if we look at revenue, you can see the analysts are estimating that revenues can grow from 6.5 billion to around 9.5 billion in next 5 years. Now what Wisdom Owl thinks that their revenue can grow at 15%, right? If their revenue can grow at 15%, they can go from 6.5 billion today to around $11 billion by 2029. Now the question is, what could be the factors which can positively and negatively influence their revenue growth? And here are those factors. And if you want to look into the details, you can log on to app.wisdomowl.ai and read this analysis for free. Now, say if the company can grow its revenue at 15% going forward, what is the right value? And the answer to that is $91. And currently, the company is trading at much lower than this $91. Now, if the company can grow its revenue at 15% going forward for next 8 years, then $91 is the fair price for the business. And currently it is trading at $17. Having said that, this $91 includes 15% revenue growth for next 8 years, right? Even if the company can grow at 10% revenue growth for next 8 years, the price would be somewhere between $17 and $91. So $17 looks like a good starting point to take a starting position, and then keep monitoring the revenue growth and read this analysis on app.wisdomowl.ai to get deeper insights into Lyft's business. Thank you.